Welcome to this explainer. Today, we're unpacking a massive shift happening right now with a brand you almost certainly know, one that's undergoing arguably the most fascinating corporate transformation in the market today, Exide Industries. Now, for decades, Exide has been completely synonymous with traditional lead-acid batteries. Honestly, if you drive a car or ride a motorcycle, there's a really high chance you've relied on their products. But the world is changing fast, and Exide is making a massive, capital-intensive pivot straight into the electric vehicle future. Over the next few minutes, we're going to unpack exactly how they're attempting this monumental shift, what it actually means for their financials, and the very real hurdles standing in their way.
Okay, let's dive into this. We'll be walking through 5 clear sections today. First, their legacy battery dominance. Second, that massive electric vehicle pivot. Third, their overall financial health. Fourth, current stock performance. And lastly, recent news and some serious supply chain challenges.
Section 1. The Legacy Battery Giant. Before we talk about where Exide is going, we really need to understand where they are right now. Exide Industries Limited isn't just a player in the market. They are literally India's dominant force in power storage. To grasp that, let's look at their core business, which breaks down into 3 strategic clusters. First, the automotive sector. This is your everyday consumers and big auto manufacturers. They supply everything from two-wheelers to e-rickshaws, and they totally dominate the high-margin retail replacement market thanks to this massive, unrivaled dealer network. Second is the institutional B2B segment. This is the critical infrastructure stuff. Telecom, data centers, the Indian railways, solar projects, and get this, even specialized batteries for Indian Navy submarines. Finally, there's their international business. Exide exports to over 60 countries, making up about 8% of their standalone revenue. Plus, they have a massive structural advantage, backward integration. Through their subsidiary, Chloride Metals, they run 3 lead recycling plants, which gives them a super stable in-house raw material supply for this legacy business.
All right, moving to Section 2, the electric vehicle pivot.
A rock-solid legacy business is great, but in the 21st century, Exide knows the internal combustion engine isn't going to rule forever. So, to pull off the leap from old-school lead-acid to cutting-edge EV tech, they created a wholly owned subsidiary called Exide Energy Solutions Limited, or EESL. And crucially, they didn't just wing it alone. They secured a vital technical licensing partnership with China's SVOL to Energy Technology. And this brilliantly illustrates the sheer scale of their ambition. 12 gigawatt-hours. That is the target capacity for their brand-new greenfield lithium-ion cell manufacturing plant in Bengaluru. And this isn't just a pipe dream on a whiteboard. They are executing this right now in 2 massive 6 gigawatt-hour phases. This gives them a huge early mover advantage as one of the very few legacy Indian auto ancillary players with a concrete, local cell manufacturing blueprint. Oh, and they aren't even waiting for Bengaluru to finish. EESL is actually already assembling and selling lithium-ion battery modules right now from another facility in Gujarat.
Section 3, financial health and shareholding.
Let's see how this massive EV expansion is actually impacting their balance sheet, because building gigafactories from scratch is incredibly expensive. Looking at the FY 2025-26 financials, we've got a company with a strong market cap of roughly 32,810 crore rupiah. Operating income is super healthy, hitting 17,995.4 crore rupee, up from the previous year, with profit after tax sitting at 859.4 crore rupiah. Now, their debt-to-equity ratio is fantastically low at just 0.11, and they boast a top-tier AAA stable credit rating. But let's use the why behind the number technique for that return on equity, which is sitting at a remarkably low 6.14%. Why is it so low? Well, while their traditional business has seen modest sales growth of around 11.7% over the last 5 years, this low ROE directly reflects the intense, massive capital expenditure they're pouring into these new lithium-ion facilities. Gigafactories have a very long gestation period. You're sinking in a ton of money and time before they start spitting out high returns. So who exactly is holding the stock while they build this future? Looking at the shareholding pattern as of March 2026, there is some serious foundational belief here. Promoters hold a commanding 46% stake. That is a lot of skin in the game during a pretty risky transition phase. The public holds 24.6%, foreign institutional investors have 10.3%, other institutions are at 10.2%, and mutual funds rounded out at 8.9%. It's a really well-diversified institutional base backing this whole corporate pivot.
Section 4. Stock Performance and Trends.
Now, what's really interesting about this chart is how the market is visually pricing in this transition. You can see the current close is at 385 rupees and 65 cents. When you place that right in the context of their 52-week high of 431 rupees and low of 287 rupees, you get the picture of a stock that's had some really strong rallies, almost certainly driven by that EV optimism, followed by periods of cooling off and consolidation. The market is essentially playing tug-of-war, constantly weighing their steady, slow-growing legacy cash cow against the very capital-heavy promises of their lithium-ion future.
Finally, Section 5, Recent News and Challenges.
Let's pivot to the immediate market reality. Because that market hesitation we just talked about, it's not without reason. There are significant headwinds currently challenging all this EV optimism. Looking at the latest news updates from May 6th, it's a bit of a mixed bag. Management does expect overall revenue growth to improve next year, but right now, they are getting absolutely hammered on the cost side. There's a sharp rising commodity exit prices that is severely impacting their margins, especially over in their U.S. markets. They're actively monitoring it and planning to raise prices to shield themselves, but the raw material pressures are undeniably intense today.
So the crucial point is really highlighted right here. Look at this terrifying spike. Sulfur and sulfuric acid prices were sitting at a totally manageable 15 rupees per kilogram last year. Fast forward to March 2026, that jumps to 58 rupees. By April 2026, skyrocketed to 74 rupees per kilogram. That is literally nearly a 5x increase. Sure, Exide has that brilliant lead recycling strategy for stability, but they are still highly exposed to global volatility for other raw materials. Combine this crazy cost spike with the fierce competition they're fighting in the legacy market, from organized players like Amara Raja and unorganized local guys, and you easily see why their margins are under siege while they're simultaneously trying to fund the gigafactories of tomorrow.
Which brings us to the ultimate question for this explainer. Exide is undeniably making the bold, right move by aggressively pivoting to lithium-ion and locking in that massive early mover advantage in local Indian manufacturing. But building out 12 gigawatt-hours of infrastructure is a very long, very expensive game. So will this massive EV gamble start paying off before these intense raw material pressures and fierce legacy competition weigh down their pristine balance sheet? It's a high-stakes corporate transition that is absolutely fascinating to watch unfold. Thanks so much for joining me to figure this out, and definitely keep an eye on those commodity prices.